Good afternoon, everyone, and a warm welcome to the conference call for CRISIL Analyst Meet. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Before we start, as a standard disclaimer from CRISIL, we would like to state that certain forward-looking statements during our interaction today are based on our current understanding of the company profile and market conditions. These are subject to change based on changing policies of the company and macro environment. The company does not undertake to update the forward-looking statements or other information contained in the presentation, whether as a result of new information, future events, or otherwise. As a policy, company refrains from giving specific quantitative guidance on its future performance. Further, in the interest of fair disclosures to investors, operational details relating to specific business segments, customer contracts will not be possible to be disclosed. Let me now hand over the call to Ms. Preeti Arora, Business Head, CRISIL Global Analytical Center and Chief Strategy Officer, CRISIL Limited, to commence the proceedings. Thank you, and over to you.
Thank you, Faizan. Good afternoon, everyone, and a very warm welcome to all present who have joined in virtually for the CRISIL Analyst Meet. Hope all of you are keeping well. So let me start with sharing. With a strong focus on growth and sustainability amidst changing and volatile environment in 2021, CRISIL converted uncertainty to possibility and caution to hope. We continued with our strong leading position in the ratings and research business in India. We also unlocked possibilities through our innovative solutioning by extending risk transformation and regulatory offerings for our global clients. Through our ESG research, data and insights, we provided actionable intelligence to our clients and contributed to sustainable progress. Using state-of-the-art technology, we launched new digital solutions, helping clients in strategic decision-making, in performance monitoring, and in managing risk. 2021 was yet another year where we strongly led with people-first approach by promoting gender inclusion, enhancing skills for our people, and nurturing our talent towards being future-ready. Being purpose-led helped us deliver strong business results. We believe our work in 2021 will continue to drive impact and innovation, create value, and help build sustainability for years to come. You will shortly hear from my colleagues and CRISIL leadership team towards this. Let me start with introducing the panelists for the CRISIL Analyst Meet today. Amish Mehta, MD and CEO, CRISIL Limited. Sanjay Chakravarti, President and CFO, CRISIL. Gurpreet Chatwal, Managing Director, CRISIL Ratings. Andre Cronje, President and Head of International Business, CRISIL. Ashish Vora, President and Business Head, CRISIL India Research, Infrastructure Advisory, BIRS, CRISIL. During the course of today's discussion, we will be referring to the analyst deck that got uploaded today morning on the exchange and our website. So let me start with beginning the proceedings. I'd like to call upon Amish Mehta to present to you CRISIL's 2021 journey of creating possibilities by envisioning the future. Over to you, Amish.
Thank you, Preeti. Good evening, everyone, and a very warm welcome to each one of you. I hope you and your family are well and staying safe, and I hope good health to everyone. It is my pleasure to address you today after taking over as the Managing Director and CEO in October 2021. I would like to start by acknowledging Ashu, my predecessor, many contributions to CRISIL during her tenure, and the good work that we are continuing to see results, as we launch ourselves in 2022. I'm glad to share that during 2021 and the first quarter of 2022, CRISIL's businesses proved to be resilient, and we remain focused on delivering value to all our stakeholders. I'm proud to inform that each CRISILite took on the challenge and ensured that we continued to grow and innovate. Let me start by looking at slide 4. So CRISIL is a leading agile, innovative and global analytics company driven by its mission of making markets function better. It has a very strong track record of double-digit revenue growth over the past 10 years, healthy EPS growth, robust culture of analytical excellence and innovation, and a global footprint. More than 4,200 CRISILites across 11 countries are constantly working to ensure that we can empower our clients to take decisions with conviction. As I look at the next slide, which is slide 6, just to set the macroeconomic context, India's GDP in real terms is expected to grow 7.8% in the current fiscal to 23, but we believe the risks are now tilted to the downside. Specifically, the risks now are about geopolitics, crude oil and interest rate hikes, especially in the US, and COVID-19 also remains the monitorable. The upside risk to inflation comes from persistently high crude oil prices and record high food and metal prices. We expect consumer prices to rise this fiscal as producers will pass on higher costs. The geopolitical situation has changed the outlook for global growth, with Eurozone expected to be hit the hardest. International commodity markets have turned volatile and financial conditions have tightened owing to the risk of sentiment. S&P forecasts global GDP for the calendar year 2022 at 3.6%. As I move to slide 7, so given this context, we believe that the following will be the key trends in 2022. We expect economic growth to continue to moderate given the geopolitical uncertainty, and another key monitorable is the capex cycle revival. Our GDP forecast hinges on government spending to build infrastructure and triggering the long-delayed private investment cycle. The pandemic and the geopolitical situation will lead global corporations to reconfigure their supply chain for business continuity. The current geopolitical situation continues to impact inflation, rising interest rates in the developed economies, introducing additional volatility and impacting investor appetite in global markets. We continue to see significant changes in business models led by digital transformation, adoption of artificial intelligence and machine learning, and sharper focus on addressing credit and non-financial risk by leveraging technology and domain expertise. We are seeing significant transformation in automation and digitization for our clients and ourselves to drive better customer experience, infrastructure, process automation, and information security. The pandemic has made a compelling case for corporates, lenders, investors, and policymakers around the world to embrace sustainability in decision making. We expect a continued increase in the adoption of sustainable business practices. Let me move to slide 9 with that macro environment. We delivered a strong performance amid the disrupted economic environment and pandemic. This was possible thanks to our differentiated positioning, global talent pool, and portfolio of IP-led services. While our CFO Sanjay will give you details on the financials, I'm happy to inform that we delivered double-digit revenue growth and robust margins. Growth during the year 2021 and in the first quarter of 22 was led by strong performance across our businesses as we strengthened our position as a leading provider of ratings, research, benchmarks, data and analytics in the markets we operate in. We unlock new opportunities by working closely with clients and providing them with innovative solutions. We saw good traction for our core offerings and developed new solutions in emerging growth areas such as sustainability and risk transformation. The rising demand for skilled talent in niche areas has led to high people cost inflation. Given the focus on digital transformation and talent, we continue to make accelerated investments in both talent and technology to be competitive and future ready. Let me move to slide 10 and talk a little bit about our customer-centric approach. Our focus on customer-centric innovation and solutions remains steadfast, which is why we continue to launch best-in-class analytics and innovative solutions addressing the niche needs of our clients. This focus on client centricity bore fruit. Our net promoter score, which is client satisfaction given by existing clients, rose, and we also onboarded many new clients. In ratings, we assigned new ratings to stressed assets and structured finance products. We launched new products in credit risk pricing, regulatory reporting, industry reports, and climate risk benchmarking. We delivered risk transformation projects for global banks and financial institutions and supported clients in meeting their IBOR, FRTB, and CCAR mandates, which are largely driven by regulatory requirements. Let me move to slide 11 and talk a little bit around the talent and technology piece, which I mentioned a few minutes back. So in our effort to continue our people-first strategy, we launched many initiatives to further this approach. Our global talent pool is a key enabler of growth and helps us deliver stakeholder value. We continue to make investments in our talent pool through upskilling, developing leadership programs, developing the leadership pipeline, and keeping pace with market practices as we prepare ourselves for the future of work. To continue providing our employees with a culture of care and shared values, we launched our diversity, equity, and inclusion statement. Our focus on our talent continues to be relentless, and we continue to invest in our talent. Along with talent, I think technology is another key enabler, and we are making significant investment in technology to accelerate our growth and enhance our digital quotient over the course of this year and going forward. As I look at slide 12 and our commitment to sustainability, it is an important focus area for us. We have adopted sustainability as a strategic approach with an aim to minimize our carbon footprint and protect the ecosphere of the communities we work with. We also strive to provide a comprehensive and best-in-class suite of sustainable offerings across our businesses, including evaluations, scores, analytics, and services, along with thought leadership through flagship events and publications. I think just a list of the awards on slide 13 across the multiple awards that we have won. We continue to be certified as a great place to work for the second year in a row. Some of our products, like the Scenario Expansion Manager, was recognized internationally for modeling innovation. We received multiple recognition for diversity, and our CSR efforts are recognized as CRISIL Foundation won the CSR Foundation of the Year award. I would like to summarize by saying that we are sitting on a good platform. We have had a very good year, 2021. Our start for 2022 first quarter has been robust, and with the strategy that we have laid out for ourselves, the talent and the technology as a key enabler, I think we are on a journey of driving growth and profitability. With those words, let me hand over to Sanjay to walk you through the financials. Sanjay, over to you.
Thank you, Amish, and good evening, everyone. I am on slide 15, and as you can see, there are two sets of graphs there. One is Q1 2022 as compared to the last year's first quarter, and the other one is the full year 21 compared to last year 2020. Let me start with 2021. As Amish said, we had a good year. It kind of showcased the resilience, the business model, the talent, and the technology that we've been able to use to drive the business results and drive the business as is. We've seen healthy growth across all three segments in the year 2021. Growth essentially led by our research segment, which in turn, in that segment, growth has been driven by our global businesses. It is my pleasure also to let all of you know that Greenwich, which was an acquisition that we made in the first quarter of 2020, Greenwich for the full year of 2021 has turned profitable, something that we were clear and determined to achieve, and we've been able to do that. On the India research side, we've also seen good growth, which has been on the back of heightened capital market activity, and ratings too, as you would note in the later slides, has also shown robust growth. As far as profitability is concerned for the year 2021, the robust revenue performance has driven our profitability growth, whilst at the same time we've continued to keep a close eye on operating leverage and costs during the course of the year, because 2021, as you all would know, also had certain uncertainties on the pandemic side. Not that notwithstanding, our revenue performance has driven profitability growth with pretty healthy flow through that has happened on account of the delta revenue that we've got over last year. When you compare it with the delta profits that we've had over last year. The one point that I would want to point out to all of you, the PAT, that is the profit after tax number that you see of 465.8 crores against the 354.7 crores, includes post-tax profit from the sale of a non-core real estate asset. When I move on the first quarter of 22, the performance traction has continued. We have once again seen growth across all three segments, with the research segment delivering growth and leading that growth traction. I would want to point out here, though, that growth in the research segment, especially on the global side, does have a base effect, because we had an especially weak quarter one last year on the global benchmarking business. However, that has turned around, and we have seen growth getting very well delivered, not only across all our three segments, but once again, led by our research segment. When we look at profitability, again, profitability with the profit achievement that we've got in our global businesses, we've been able to drive growth of profit driven by revenue and by operating leverage into all the three segments that we have. It would be pertinent to point out here that the first quarter of last year for the Greenwich business was a loss. This year's first quarter has been a profit, so that also has driven the kind of growth that you're seeing in profits. Again, you will note that the revenue growth that has come through in the first quarter has also driven profitability growth, once again giving you a fair idea that we continue to have cast a very close eye on operating leverage and cost at the same time when we want to drive revenues in all our business. Before I close the synopsis of the first quarter of this year and the last year, I would want to point out that, as Amish pointed out, two of our most important pillars of business growth and business traction will be talent and technology. We will continue to invest in talent and technology both in the near term and in the midterm and long term. And you will see those numbers coming in both in the near term and in the midterm, as also the revenue that these investments will drive. With that, if there are any questions, we will take them in the Q&A section. I would now like to hand over to Gurpreet for a briefing on the rating segment. Gurpreet, for you.
Thanks, Sanjay, and good evening, everybody. I'll take you through the segmental performance for ratings for Q1 as well for the last year, which is 2021. As you are aware that the revenue pools for the domestic ratings agencies in India is mainly determined by the growth of the corporate bond market, as well as the credit growth for the bank loan revenues. In the corporate bond market, we saw a decline of about 23% in the corporate bond issuances in CY21, and also Q1 in 22, we saw a decline of about 22%. This is largely on the back of rising and volatile interest rate that was prevalent for most of the last year and YTD. A rising interest rate usually don't augur very well for the bond market vis-a-vis bank loans, because bond markets price that instantaneously, and bank loans usually go to the lag. Also, from the bond market perspective, the growth outlook for NBFCs, which is usually one of the larger issuer segments in the bond market, was also muted during the last year, which is 2021. So basically, on an overall basis, we witnessed that the number of issuers that tapped the corporate bond market in 2021 actually dipped by about 26% to 340, and the highest which we saw in the last 4-5 years was almost 600 plus. So now let me move to the next segment, which is also a key determinant for the rating revenues for the industry, which is the credit growth by the banking sector. While the credit growth was muted for most of 2021, and the wholesale credit growth actually came to sub 3% for most of 2021, you can actually see it from the graph. We observed an uptick from the December 2021 onwards. We observed actually an uptick in the bank loan ratings for existing as well as new customers in Q1 too. And that's the segment which we are seeing a positive traction going forward. We understand while some of these bank loan ratings are migrations of the large corporate bond issuers from the bond market to the loan market, but we are also seeing an uptick in lending in the growing infrastructure segment, as well as increase in working capital requirements with the sharp economic rebound we saw the second half of last year, as well as high commodity prices. CRISIL Ratings actually estimates an improved banking credit sector growth to be about 11-12% in FY 2023. Emanating from all segments, including large. If you move to the next slide, This slide talks about one of CRISIL Ratings' biggest strengths and focus area, that is analytical rigor and quality of our rated portfolio. The table shows here that the one-year investment grade default rate averaged over 10 years. This is something which SEBI mandates for all rating agencies to publish this data. This is for FY 2021, and the FY 2022 data will be available early May. You would see that we have consistently maintained best-in-class default rates across rating categories for our rated portfolio, much better than the other rating agencies across rating categories. We believe that this is one of the key statistics that lenders and investors look very closely at when they evaluate rating agency performance, as well as determine the rating agency of their choice. We have been working and are working continuously to enhance our early warning framework that helps us in targeted surveillance of our portfolio and maintain high rating quality. If we move to the next slide, let me take you through the segmental 2021 and Q1 2022 financial performance. We saw revenue and profitability growth in the rating segment in both these periods, emanating from issuer, investor, and banker preference for CRISIL Ratings for their borrowing programs. We continued our focus on client engagement initiatives and strengthened our leading position in share of voice in the Indian media amongst CRAs based on our thought leadership publications and webinars. Global Analytical Center sustained its analytical surveillance support across all practices and continued to drive the data and technology transformation agenda at S&P Global Rating Services. Thank you, and I'd like to pass on to my colleague, Andre.
Thanks, Gurpreet. So on the revenue side for the wholesale and CIBs, markets have continued to have good revenue growth. It sort of balanced itself out. Capital markets grew because of the volatility and uncertainty in the market and enhanced trading revenues. On the banking side, it was more moderate, and as a result of the benign interest rate environment, and also as a result of the uncertainty in the market, and some of the deals and M&A transactions that were planned were either delayed or postponed. But it seems as if revenue towards the end of the year started to recover to sort of pre-pandemic levels. Demand for benchmarking and competitor intelligence remains high, obviously in an environment where banks are continuously searching for growth. Capital and balance sheet recovery continues, and in a sense, the balance sheets of the banks are in fairly good shape. ROE is improving, and the demand for the capabilities that we have in GR and RS, especially in traded risk, model risk, and RWA reduction, was in high demand. On the regulation side, it's still a very heavy regulatory environment. Evolving regulations, ESG, and incorporation of financial reporting has resulted in demand for ESG services, which is one of the key strategic pillars that we are developing at the moment in our GR and RS business. Enhanced reporting requirements for derivative trading continued, uncleared derivatives, and then harmonization of regulations between the US, Europe, and APAC continues. Key developments: Basel IV, CRD, ICAP focused on increased capital requirements. Our credit and model risk practices experience continued demand for services as a result of it. Climate risk models and quantification of its potential capital impact present new revenue streams for GR and RS. For the Indian market, assets under management of the domestic mutual fund industry surged further in 2021. This was in backdrop of better market sentiments, digitization, and accelerated financialization of savings. The mutual fund assets under management has seen steady rise over the past few years. Investments in newer financial instruments also continue to pick pace, especially in the alternative space, where commitments rose sharply during 2021, leading to a need for performance benchmarking. In addition, we saw healthy fundraising activity, with many corporates and startups accessing the capital market. On the financial sector, credit growth is expected to pick up, with corporate credit to shift to a higher growth trajectory. Asset quality is expected to improve, which augurs well for the overall financial sector. Our focus also continues to be on sustainability and green lending, as clients demand data, research, and independent opinion on sustainability. There is also material opportunity emerging around ESG capability building within organizations. I'll now hand over to talk to the financials. As Sanjay has mentioned, for the research, we've seen a fairly good recovery throughout 2021, and it's repeated in Q1 2022. Segment profitability up, good margin improvement from Q1 21 to Q1 22, and that margin is reflective on the for the year 20 to 21, which indicated good recovery, especially in the benchmarking business, where we've had the acquisition of Greenwich, which initially was a drag, but made good recovery throughout the year towards the end of the year. I'll now hand over to Ashish.
Thanks, Andre, and good afternoon, everyone. Just as a point of reference, I'm on slide 26. So I'm just going to talk through some of the trends that we are seeing relevant to the advisory business. The two key themes really being, one is focus on infrastructure, and the second is really around technology adoption, which is creating needs for advisory services, analytics, and digital solutions. Specifically on the infrastructure advisory side, what we're really seeing is that there is higher budgeted infra capex being proposed year on year, and the areas of focus are really roads, ports, logistics, and energy. There is a higher allocation under the PLI scheme to give a fillip to the renewables and the sustainability themes. And there's also diversification in long-term funding sources for infrastructure investments. And that's really, the diversification is really coming in the form of green bonds, in the form of foreign investments from a long-term perspective, the PPP model, asset monetization, and the setting up of InvITs. In addition to all of this, you're also seeing an increasing emphasis on advisory solutions by clients in India around emerging new solutions to help mitigate climate change. On the business intelligence and risk solutions side of the business, we're really seeing a significant demand for integrated credit and risk solutions. And when we say integrated, it's really data analytics and customizable workflows to embed themselves into a, so to say, business process. There's the focus on digitizing client and internal processes to enhance user experience and to get productivity. We're seeing a lot of banks move towards that. Financial services firms are also accelerating their migration to the cloud with a preference for implementation like SaaS-based models. And lastly, due to the constantly changing regulations, we are seeing a demand for platforms related to reporting and related to compliance and regulatory reporting. To move on to slide 27, as you can see, quarter one from operations, we grew about 10% year on year. For the full year, we grew about 14% between 2021 versus 2020. And segmental profits have also grown significant from 57 in the range of 50 to 60 odd percent, depending on the periods that you're really comparing. The advisory segment saw good momentum with revenue growing at 10% and, like I mentioned, 14% during the quarter ended 21. The infrastructure business specifically won mandates from multilaterals and the private sector and expanded its overseas client footprint. While the BIRS business, or the Business Intelligence and Risk Solutions business, saw tractions for its client risk and regulatory solutions, the reporting solutions, and deepened its wallet with existing and our international clients. With this, I'm going to hand over. All right. I'll walk you through the risk section after this. If we given I think a lot of this has been covered in the earlier parts of the presentation by Amish and Sanjay, but just to sum it all up or summarize it, one of the risks that we are really living with, given the dynamic environment, is the current geopolitical environment risk that we live in, which may have implications on the global trade, supply chains, commodity prices, and therefore, an impact on overall economic development. The other risk that we really see is that of rising people inflation, and hence, we have formulated and implemented policies focused towards retention and development of skill sets of people. The third risk that we really see is associated around currency movement, where we do have a sizable amount of revenue coming from outside of India, and hence this is a key monitorable for us. I think to sum it up, it's really a lot about having a very robust internal mechanism to review risks and to be able to evaluate mitigating strategies at regular intervals so that you have a complete control on the risk environment or complete control on the business environment that we really operate in. With this, this kind of concludes our presentation, and I'm going to hand this off to the operator for next steps here.
This is the operator. Should we start the flow for questions and answers?
Yes.
Thank you, everyone. We would now like to open the floor for questions. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Rajiv Mehta from Yes Security. Please go ahead.
Yeah, hi, good evening everyone. Firstly, congratulations on a strong performance in CY21 and first quarter, and thank you for taking my question. So the first question is on domestic rating. So we have had very 2 strong quarters in terms of revenue growth in domestic rating. So fourth quarter last year we grew by 16% on revenues. This year first quarter we grew by 13.5%. So when you look at this growth in a very muted kind of a lending market activity, it really implies significant market share gains for us on an incremental basis. So if you can comment on the market share movement of CRISIL in the recent quarters, has it accentuated, and is it in the BLR market and not in the bond market, and what were the key reasons here?
Okay. No, thank you, Rajiv. Yes, I think there has been market share gains for us, but that's a continuous process since the last, I think, 3 or 4 years. I think the movement upward started somewhere around after the IL&FS default, which we didn't rate, and subsequently a couple of other credit cliffs which we didn't rate. So I think that's how I would want to put it. I think the reason we put the slide on default rates, I think that's usually people just glance over it actually. But that I think has been playing good in terms of the investors, lenders' mind. I think people have been conscious in terms of looking at rating agencies, ratings and doing that. So I think that's what I would broadly give a perspective. So yes, there has been slowdown in the corporate bond segment, and bank loans have recently started picking up. But yes, I think it's a movement over a period of time, not something just happened in 2 quarters.
Okay, got it. So the recent share gains would have come largely in VLR segment? Because you spoke about a lot of large corporates, migrating to VLR side from the bond side.
No, that's a trend. I just try to give a perspective in terms of the reason why we've seen bond market declining and bank loans picking up. That doesn't necessarily mean in terms of how on a quarter-on-quarter basis we get our revenues. The revenues for rating agencies, if you understand, I mean, I'm sure you've been tracking us for some time, has 2 components: surveillance revenues, which come for business you've contracted in the past, usually a longer period of time. So I think that is continuous revenue, and that also builds up on quarter-on-quarter based on what happened 18 months back. I mean, I'm just giving you a broader sense. And then you have new revenues which are based on what bonds come to the market at that point in time, and who is rating them. I think that's the larger perspective. So that aspect I was trying to explain was the larger bond market, because that everybody tracks. It's decline and the banks don't growing. But yes, it has a broader correlation if you were to look at for a year perspective or a 2 years perspective. A quarter-on-quarter could be different.
Got it. And how significant is stressed assets rating and securitization rating for us in terms of materiality in the overall domestic rating piece?
So the question, okay, you asked about stress and securitization. I think I mean, we don't put these numbers out. I would say not very large, but we don't put exact percentage.
Okay, thank you. And I had one question on GR and RS business. Just to understand the significant growth that you've delivered in the recent years better. So from our understanding perspective, how should we kind of map this growth in terms of what were the key underlying factors? What kind of spends were done, in which areas, or what did a regulatory push that drove demand for, these services that we offer? And also, in terms of competition and our right to win, so where do we stand in terms of our key capabilities and our right to win in order to get this mandate and delivery?
So, Karthik, I would say that first of all, a couple of areas in GRRS, right? So, if you were to look at the strategic thrusts, and we call those out in terms of trends, where are the clients spending money globally? I think they are spending money on non-financial risk, on digital transformation. They are spending money on sustainability. So I think there are a couple of themes which are playing out very clearly. And I think those are themes where they are looking for support on data, on research, on underpinning them on intelligence. I think those are areas where we are seeing demand from our clients, in addition to the normal areas that we would be working on. And during the pandemic, of course, the need for services, support outside has continued traction. So I think we are seeing ongoing requirement for that. In addition to that, there are themes which are playing out. And I think that those are the ones which we called out in our, in my slide on trends. And then we clearly continue to see traction in the business. Of course, there will be some parts of the business, which will always be, muted in terms of growth, and there will be other parts of the business where we will continue to see opportunity. And I think all of you are aware in terms of the global research business, sell side versus buy side. I think those are the two trends which I'm sure all of you know. So I think some parts of the business will see, muted growth. Some parts are seeing, higher growth in terms of demand. And of course, there are segments out there where we are seeing more spend from clients, which means good for our business. These are some of the areas where you should expect, traction and growth going forward.
Okay, thank you. One last question on benchmarking analytics business. So can you give some color in terms of shift in the momentum of business post Greenwich integration and turnaround? Maybe in terms of the velocity of deal win, deal sizes, maybe some qualitative comments on wallet share in existing large relationships, and maybe even in terms of new client addition, in terms of where we are or how are we improving on these parameters once we have seen the integration of Greenwich operations.
So Greenwich has been a part of our strategic journey, right? I mean, and it was more to drive benchmarking across the financial services spectrum. So with Coalition franchise that we have, we were strong on the CIB side, whereas we wanted to drive momentum in terms of benchmarking across the financial services space. Also, Coalition is much more quantitative, based on numbers, whereas Greenwich provided us the opportunity to look at qualitative and also add predictive to the qualitative part. So, bring the best of quantitative and qualitative together. It allowed us to expand into segments like investment management, and community and commercial banks, in addition to the CIBs that we had. So I think that acquisition of Greenwich was a part of our planned strategy to expand in the global benchmarking space. Yes, it happened just before the pandemic, and we did see some impact in 2020 on our financials. But I think as we integrated the two businesses together, as we have been able to leverage the value of the acquisition, clearly we are able to go, with a combined offering to our existing clients. We are able to also expand the customer base. We've got completely new set of clients on the Greenwich side, which allows us cross-sell on both sides of the spectrum, both qualitative and quantitative. So we could go to CIBs and position the larger offering, and we can go to the non-CIBs, which is asset management companies and the CCBs on some of our other offerings. So I think we have been able to leverage the value out of that acquisition, and which is where you see a strong recovery and momentum in 2021, where we have been able to get the value come back and the value of the offerings. I would say, there is potential in this business. And as we bring the two together, as we bring the value of the insights together to our clients, as we bring the data and the intelligence together, I think we should be able to build much more predictive capability into our analysis and intelligence, which should allow our clients to see value from the offerings and allow us to expand our share of wallet from existing clients as well as add new clients to the portfolio. So overall, I would say, it's been a good journey. We've seen a turnaround that is reflected in the numbers for 2021, post the acquisition that we did in 2020.
Yes. Thank you so much for answering my questions.
Thank you. The next question is from the line of Karthik Saini from Myriad Asset Management. Please go ahead.
Hi. So my question would be around your tech and talent. As you said that you have been investing heavily in this segment, and I see your margins. EBITDA margins has been around 26%, the average, if I see the last 3 years. But this quarter it was around 30%. So I want to understand, where do you see these margins stabilizing in the long run? And also, if I look at your fixed assets turnover, which I see has been declining. So I just want to understand your cost and how do you see the operating leverage playing out?
Sanjay, do you want to address that? Maybe I can add on.
Sure, Ramesh. First things first, Karthik, I don't think it will be correct to look at the one quarter's numbers when you look at the margins that we've earned. It's always best to look at margins for the full year, because there are cyclicalities to certain businesses, as there are cyclicalities to the macro environment that we operate in. So when you look at our annual margins that we've been able to deliver over the last 3 to 4 years, yes, there has been margin expansion. We will continue to target growth in margins. As you know, we don't give forward guidance, but we are very clear in each of our business segments. We will continue to target margin growth, and at this stage, we do believe that every business segment, as every business in those segments, have headroom to continue to deliver margin growth. As far as your second question is concerned, which is your fixed assets turnover, I don't have the numbers right here in front of me, but the fixed assets turnover, if you look at it, given the investments that we are making in our business and will continue to make, I think you will see some level of, what should I say, non-linear change in that ratio. But ultimately, if you were to draw a trend line, you will find that our FA to turnover or the fixed asset turnover ratio, you will see that growing also. Amish, would you want to add anything?
No, I think, you answered that. If there's any further question, I can address that.
Okay. Thank you. And my second question is around, I see that you have hired around 1,200 odd employees that you say are new age and techno functional. So can you share sort of colleges or universities you are targeting for this?
So, can I request Anupam, who is our head of HR, he's also on the call. Anupam, we want to just maybe address that.
Sure. Hi, this is Anupam here. I think for us, these 1,200 people largely represent experienced talent that we've hired from the market with a combination skill set in that they have a financial services domain and a combination of either quant skills or for that matter, technology skills. Yes, some bit of thrust has definitely happened in terms of hiring from campuses as well. So for campuses, we visited a lot of MCA colleges. We've resorted to some unconventional sources as well of hiring. We've curated in the hire and train model as well. And of course, we've gone to some of the B schools and engineering colleges as well. So, but overall, if you ask me, of the 1,200, I would say only about 15% would have been fresh talent. The rest of it is very much lateral talent.
Okay. Thank you so much for this. All the best.
Thank you.
Thank you. The next question is from the line of Chaitanya Shah from Silverlight Capital. Please go ahead.
Hi. I want to talk. I wanted to understand around the technology part. In the introduction, you spoke that there's a lot of use of
Shah, sorry to interrupt you, sir. We are not able to hear you clearly.
Hello.
Yes, sir. Please go ahead.
Yeah. So I just wanted to understand from the technology part. Now, you're speaking about how technology is affecting your business and how you're investing in technology. So just wanted to understand broadly, the use of artificial intelligence or machine learning or, new technologies like blockchain. Do you see that as a threat or an advantage to your business model? And if you could give, the reasons behind how you think about this.
So, I would say that I think we see that as an opportunity, not as a threat. Clearly, in two ways. One is for the clients we serve, right? So I think they are looking at us to help them on some of these areas. And also for our own business itself, I think each of these are an opportunity, as we look at whether it is AI, ML or blockchain. And we continue to evaluate all the emerging technologies, the relevance for us and for our clients, and make sure. And that's why I think we use the word ready, because at the end of the day, all of us, any organization who is working, with clients and where technology is relevant, I think we'll have to start looking at that roadmap and see how it is relevant. I think the point which I would also say that we keep looking at the mirror to see if there's any disruption which will happen because of these technologies. So yeah, to that level, it could be a threat. But I think that is something which each organization has to continue to look at. So that's how we look at it.
Right. And sir, I stay in Mumbai, and recently I've been seeing billboards of prestige estates claiming that they are a DA1 developer rated by CRISIL. So I just want to understand: is this a new product that has been launched, and what's the potential of this particular business?
No, so this is an existing product which has been there. It's not a new product. It's been an existing product which has been there for many years. So I would say it's a part of our existing portfolio.
Okay, all right. Also, one question I had on the ESG segment. Now, I was reading the annual report of your parent, S&P Global, and they said that ESG could be more than $500 million opportunity for them in a few years. So I just want to understand from this point of view, what is your view on this and what is the potential of this business?
So I would say that there are multiple opportunities one needs to think of. And if you look at data itself, I mean, that's one part of the opportunity. Then you have evaluations, you have assessment, you have capabilities, you have consulting. So I mean, there are multiple threads which could be on ESG, and depending on what areas, what capabilities you have and what areas you choose to operate in, I think the addressable market will get decided. So I would say the market is large, it is evolving, it is growing, and I think it has enough for players like us to work on.
Right. Okay. And I just have one last question. In your presentation, you mentioned the credentials of your company in the ratings business. Is there similar disclosure, that you internally have in terms of the research segment, in terms of giving what would be the accuracy of the research that you provide, which would, demonstrate the credentials of the company? Do you have something? Do you have a disclosure like that can be tracked by us?
So and I think it's a good question that you're asking, because a lot of clients ask that question to me, to be very honest, saying that, Ramesh, you put out forecasts. Have you done back testing to see whether this is really good or bad, and the reasons for that? So I would say, this is a question which and I'm sure my team gets asked, every client discussion we have. So of course we track, our forecasts, and internally we look at, how good or bad, where have we gone, right or wrong, what have we done, what assumptions have we made, to make sure that we are looking at it closely. The challenge here is nobody else puts out anything, so it's very difficult to measure it very transparently with competitors. In case of ratings, as you know, this is an ask which comes from SEBI, so all companies have to publish the data. It becomes easier to compare. So that's something that to keep in perspective. But yeah, I would say internally the team does look at the forecast that we put out on the research side, and also how are we doing.
Okay, all right. Thank you so much.
Thank you. The next question is from the line of Devam Modi from Ardeco. Please go ahead.
Yeah, thanks for the question. So actually, just wanted to get a sense that on the rating front, what would be the revenue yield as a percentage of and if you provide a flavor.
The audio is breaking from your line, sir. Please check.
Sure. Is it better now?
Yes, sir.
Yeah. So to begin with, just wanted to get a sense of what is the rough revenue yield as a percentage of total debt rated. And if you could provide a flavor on how one can expect this yield to change over a period of time, and the level at which it is right now, would it be one of the lower levels, or how would it be across from a cyclical point?
So let me talk about the rack rates we have, what we put out on our website. So basically, for a corporate bond, the initial rating fee is about 10 basis points for the debt to be rated, and for bank loan ratings, 4 basis points. I think that's the rack rate. The yields are lower on both sides. So over a period of time, I think we've seen a little bit of movement on the upside over the last few years, but not by a large amount of. But yes, the yields have improved. I would say this is over the last 3 to 4 years. Going forward, I won't be able to give guidance, but these numbers don't change very substantially. So if you were to ask me, does it yo-yo between 10 and 90? It doesn't. So it remains at similar levels, maybe 5-10% upside or downside, because it's on a very large base on customers. But please understand, when you're making projections, is the fact that what gets issued in a quarter can have various flavors. You could get a new issuer coming in, and he's the first time, so he pays higher. It could be an existing issuer who's under a fee cap, who actually pays nothing. So it's the composition of debt which comes in that quarter, which kind of can make a difference in the numbers. But usually when you look at over a year period and average it out, I think that kind of that's usually comparable. Year-on-year numbers are usually comparable. So I kind of broadly answer it this way. Hope that makes sense.
So just to probe it a little further, I mean, when we look at the industry level, we understand that the yield is very low. I mean, it is below even 1 basis point. I mean, it can be below 0.5 basis point. And would that be partly justified by the fact that new bond raising would be sort of at an all-time low, plus the fact that a lot of these revenues in the last 2-3 years might majorly be dominated by surveillance, and there would be lack of, so let's say, a good paying customers bond raising, like a lot of bond raising might be high quality AAAs for which it will be more of a league table raise. Would that be the correct understanding of the industry? And are you at a point wherein with the credit raise or the credit environment warming up, you should probably see a change in this structure which has been persisting for the last couple of 2-3 years sort of?
So, okay, let me argue differently. I think I get where you're coming from. Yes, I mean, what I talked about rack rates was IRF. The surveillances are roughly about half of that. So now let me preface it differently. So there will be issuers who issue almost 1 lakh crore of debt in a year. So those are capped. So whether the issue is 1 lakh or 110 or 90, the incremental doesn't give you anything. So, which is why that explains that basis points you're talking about. So if you were to really, I mean, if you're looking at a forward-looking measure, then how many new issuers come to a market? That's why if you see a lot of time, I talked about that too. How many new issuers come to the market will give you a sense that they will be probably more yield accretive than the existing. So if you have a 10, 20% or 30% growth in the bond market and the new issuers actually decline, you will probably see those kind of numbers. So I think that's a larger perspective. It's complicated, and sorry, I can't make it more simple than this, but it's complicated. So if you were to really do it, you're going to dig deep into who are the issuers coming in, what kind of debt they're coming in, are they capped, are not capped. It's difficult for us to also kind of, if we were to draw this comparison for other rating agencies, we don't really get answers which match with their numbers. So it's, but the basis points which you're talking of are cognizant of the fact that in India, some very large issuers dominate the bond market. So if you were to take the top 10, 15 out and then look at the numbers, I think that'd probably give you a little bit more predictive power, but I'll leave it at that.
Sure. And the rising EBIT margin that we see on the ratings front, would that be attributed, it would be a combination, I'm sure, of operating leverage, especially as well as probably some amount of pricing and probably tech investments and all. So how do we see that stabilizing, or can we expect it to rise further from even current levels, which is already on the higher side? So if you can just provide some flavor of thought process there.
Sorry, we don't give forward-looking guidance.
I mean, just the current EBIT margin which has risen, what would be the primary factors behind it? I mean, would it be just higher pricing because your EBIT margin growth is a little higher than your revenue growth? So would that be because of pricing, or would it also be because of operating leverage, because of tech investments or things like that?
Yeah, I'll defer to Sanjay. I think Sanjay is probably the better guy to answer this.
On this, Devam, I think it's very clear that pricing pressure has not gone away from the business. Pricing pressure continues, even though we continue to be the issuer preferred rating agency, but pricing pressure hasn't gone away. That's the nature of the market, that's the nature of the business. What we have been able to do is drive profitability, partly as Gurpreet said, through market share gains and definitely through operating leverage in the business.
Sure. And if you could give a flavor of the volume growth in Q1 CY22, I mean year on year, and if possible, volume growth direction with regards to new issuers.
You talking about the industry data? I think we put that data out.
For CRISIL per se, for CRISIL.
We don't share volume.
Yeah. We don't give out that data, Devam, on the volume. See, there are two parts to it. One of us, firstly, no one else gives it out, so we are not even, it wouldn't be correct for us to give it out on an estimation basis, and we don't give it out as that data into the public domain.
And finally, what would be the rough component of surveillance in our overall quantum, in our overall revenue, and also how do we account for the same in terms that do we account for surveillance in the quarter in which it is conducted, or do we sort of smooth it out over the entire year?
surveillance is always amortized over the period of surveillance, and the initial rating fees is accounted for in the quarter in which the contract is done.
And what would be the rough component of surveillance in the overall fee that we have?
It would typically, between surveillance and IRF, it'll range between 50-50. It might change in a couple of years depending on how surveillance has moved and how IRF is.
No, so on the current, let's say CY21 revenue, 50% would roughly be surveillance. Would that be the correct impression?
Are you saying 2021?
Yeah, 2021, the year.
No, 2021 surveillance will be higher.
So it would be what, 55-60, or I mean, just a range if you can just mention within a 5% band.
It will be upwards of 50%, Devam.
Okay, sure. And finally, just wanted to understand what are the key factors driving the margin improvement in research business. And given that research business obviously is coming off a period wherein margins are dipped, what kind of growth and further margin improvement can one factor over here in the coming 2 to 3 years?
So, Devam, there are 3 key businesses there. One is domestic research, then there is our benchmarking business and our GR&RS business. Our growth, like I said, a part of the growth has come out of the fact that the global research segment has turned around because, as Amish had earlier mentioned in a question, that we have been able to look at strategically moving in non-financial risk and risk services. Second part, the acquisition of Greenwich has helped us in driving margins and driving revenue, which has seen decent flow through. And finally, in 21, given the buoyancy that we saw in the equity market, that has also driven our domestic research business through certain products which have higher profit margins than other products in domestic research.
Sure. So just wanted to get a sense that there's been a strong margin improvement which is ongoing, and I mean for a long period of time the margins have actually dipped much lower. So can we expect this improvement to sort of continue, and what is driving this improvement currently? I mean, is it just more business, or is there also like better usage of employees? And I mean, because employee cost would have dipped down over here as a percentage of total revenues.
All the 3 factors are playing, Devam. Sorry, Amish, go ahead.
No, Sanjay, complete after you.
So I think all 3 factors are responsible, Devam. We have always looked at our costs very closely, whether it's in a bull period or in a bear period. So that continues. Second of all, our strategic pivot onto the risk side has helped. And finally, when you look at it, the way we have invested, and that investment is going to continue. We will, like I said right at the beginning when I was going through the financial slide, we believe that we have the ability to grow our margins in all our businesses, and we have the headroom to do it, and we'll continue to target that.
Sure. Thanks a lot. Yeah. Sorry, Amish, please continue.
No, I just going to add to what Sanjay said. See, I think first of all, please look at numbers on an annual basis. Don't look at a quarter, because like Sanjay mentioned, there is seasonality in different businesses. So a quarter's numbers might not be the best representation. It is always good to look at the annual numbers as a trend. I think secondly, I would say that our endeavor, and I mentioned that, is to drive growth, drive margin. I think we would always look for continuous improvement across all our businesses and see how we can get better value, better leverage, operating leverage, and continuously drive margins across our businesses. Third, I would say is that we will continue to invest on talent and technology as we need to be future ready, as we need to be competitive, as we look at driving initiatives and areas that we get into from a strategic lens. So a longer term trajectory will always be good to look at and consider.
Okay, sure. Thanks. That's it from me.
Thank you. The next question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Hi, thank you for the opportunity. I had 2 set of questions. One was on the securitization business. So if you look at the securitization market as such in India, it has been quite volatile. After hitting the peak in 2018, it has gone nowhere. Any thoughts on the market from a longer term perspective? Because if you look at the global market, that is a quite a big market in global, for like countries like US, China, etc. So how do we look at that market from India perspective, from like 3 to 5 year perspective? And second was on, the BLR business, because if we see that, like in last so many years, there have been a lot of competition, and the size of the pie has been decreasing because of the credit, the bank credit itself not growing at a healthy rate. Now, what's the sense on the pricing on the BLR? Because what we have also seen is a lot of BLRs have dropped off as well over last 5 years. Any sense on the competition and pricing on the BLR side? Because we are seeing some uptick in terms of the credit growth itself. These are the two questions that I have, if you can answer. Thanks.
Okay, so I'll give it my best shot. So on securitization, I agree with you. I think that's it's a segment of the rating business which ideally should be a larger component than what it is. It's been volatile. I agree with you. I think the recovery started. So obviously it has to be number one. I think the investors have to be comfortable. So securitization, you have banks as one of the larger investors, which is largely through DA, and then there is mutual funds, insurance, a little bit on that. So we have a pretty simple securitization market. Usually not complicated instruments are not usually liked by the market, and also the regulator frowns on that. So it's a business where a good amount of NBFCs actually used to sell their assets through this. Two things have changed. One, I think banks have been directly picking up some of those portfolios to direct assignments. But that's part of the securitization business. And the other is that because of the pandemic and the performance and the concern about the performance of the securitized assets, because it's finally owned by a trust, not by a bank or an NBFC. So what kind of regulatory leeway that was provided during that time will be available on them or not? So I think that for 2 years were played on the market. With hopefully there's no pandemic, no waves more. Anyway, I think securitized assets performed decently well in the second and third wave. The first wave was sudden. So the way I see it, I think this market will expand as we go down the road. For NBFC, it's a pretty sizable source of new incremental revenues backed by strong assets. The other area which we've been, I think, keeping an eye on is the CDO side. It's not very well evolved, but what we've seen is the recent change in the securitization guidelines where they're allowing the single loan sell downs to happen. It used to be a very buoyant market almost a decade back. It hasn't really picked up now, but from a regulatory perspective, they have enabled that. So I also believe and hope, and they're both put together, I think that will also pick up in the coming days when the large corporate lending picks up. The only restriction between then and now is that you have to hold the assets for 6 months before they securitize. Previously, they used to do it the next day. So we believe that will also pick up. So I think these are areas, but having said that, over the next 3-5 years, I think the market will grow, but it would still be a fraction of the total bond market. So that helps. But it's a pretty strong sustainable revenue source for NBFC. That much, I think, as they grow, I think this will also grow.
Sure. And in terms of regulatory side, if you look at global markets, retail assets are also allowed to securitize. Any sense on, where we are in terms of the regulatory evolution in India?
So you're talking about retail assets?
Yeah.
So the securitization in India is largely retail assets. So you have almost 99 point something is what retail assets will get securitized.
Sure.
So the CDO market isn't picked up in India. That would be the wholesale. That has, once in a while one instrument happens, and that also for a particular reason. But otherwise, it's predominantly or majority or almost all of it is retail asset securitization. It could be in the form of a direct assignment with a bank, or it could be a form of PTC, which an external investor will pick up. It could be largely.
Sure.
So that will be largely, either banks or corporate treasuries or mutual funds or.
Sure.
The The other question was on the BLR business. I think what we saw on the BLR side, the reduction in the number of clients I'm talking about the industry level, practically almost half over the last 3 to 4 years. And that's largely because most of the banks, the minimum or requirement which the banks initially used to have is about 10 crores. Now they've jacked up to about different banks 30 to 50 crores. I think that is an area which has reduced the number of people because the smaller clients actually didn't require ratings as per the new bank's internal credit policies. My sense is that that's almost all that's played out. So current universe which we rate is mostly the larger sized PLRs. That I believe, at least our sense is that will remain, and that's the current market size. What we are seeing on the other side is that yes, as we grow as an economy at that 6.5% real, I think it is favoring favoring credit growth in the country and also for the larger segment. So I think this business will grow on the BLR side. Competition, as Sanjay mentioned it, we are a 7 rating agency market. The competition remains intense in that. So that puts the pressure on pricing. It does.
Sure. Okay. Thank you so much. All the best.
Okay. Thank you.
Thank you. The next question is from the line of Gaurang with Capital Advisors. Please go ahead.
Thanks for the opportunity. Hi, Team CRISIL. Congratulations on the good set of numbers. My first question pertains to a rating segment. My question is that post-bankruptcy reforms which were implemented in 2016 and as per the experience of other countries' bond market has picked up significantly around 4 to 5 years post-implementation of IBC. So, and here we are in India as per your presentation that corporate bond issuance is just 3% of GDP. So can you please throw some color? Are we at some inflection point for development of bond market or still it is some time away? And where do you see recovery rate and timeline for resolution of NPA assets going forward in medium term? Thank you very much.
Thanks, Gaurang. I think you picked up on my previous presentation. So let me try to. I'm also refreshing my memory. Yes, you're right. I think we've seen in some of the markets significant uptick after about 5 years. I think for us, 2 or 3 things which are. I think it's a great reform. I'm not trying to criticize any of the reform. I think it's a pretty strong, good reform for the country. Is helping us in many manners. I think if you see the asset size, all the banks today, and look at the large corporate portfolio, it's as clean as it gets. I think that's one of the benefits which IBC has given. There are few. I think one thing we'll have to also notice that the last 2 years have been a little bit of an issue for not only India but globally. I think because of the whole pandemic and the bit of risk aversion in the lending markets which came in. So I think we've been pushed back up by a couple of years because of that. And I'm also, as you are a participant in the larger market development of the financial markets in the country, and so are we. So we are hoping that aspect of IBC and helping grow the bond market will come in. But finally, I think let's look at it differently. IBC's the recovery rates I don't have as of now. I think what got published is for the resolved assets. So we have a couple of publications. I don't have them with me now, but if you, we will get that sent to you. We sometime back published it. I think because of the pandemic and the delay in some of the resolution of the mid-size and the smaller size accounts, I think that's currently underway. So our sense is that recovery rate which gives confidence to the stakeholders, I think is maybe a year or a couple of years away. Because finally, with a much higher recovery rate, if you are a bond market player, which is an insurance company, because you're not a lender to the company, you're not looking at the security, you're looking at what if it defaults, what it gets back. I think that comfort has to be built with the mutual funds as well as the insurance companies, as well as the other foreign bond players. I think we are a couple of years away, but we are progressing in the right direction. I think we've seen some very large assets resolved very well. if you see the large corporate portfolio of banks, it's probably very, very strong today. I think we need to keep at it and as a country push towards resolving mid-size and smaller size assets. I think once that comfort starts building in, each of the banks, each of the components of the market will start changing the loss given default numbers in their models. And once they start doing it, I think the bond market will pick up. So I don't have a straight and simple answer for you. Yes, the metrics was 5 years, and I remember we've also very closely tracked it, UK as well as Malaysia. But India, I think the time we introduced it, the time we are now, I think there are a few hiccups which came in through pandemic and delayed and everything. But we are in the right direction, the way I would say it.
Thank you, Mr. Chatwal. That was quite helpful. My other question is pertains to other income. So the year before that, which was 2020, there was other income of around 27.5 crore of export incentives, which was not there last year. So would appreciate if you could throw some color why it was not there last year. So the government has discontinued the scheme, or can you please throw some color?
I'll take that, Gurpreet. Gaurav, it's like this. The SEIS, which is the Services Export Incentive Scheme, it was there in 2020, but the amount was lesser. In 2021, once again, we got it for the year 2020. It has not been notified in 21, so that number doesn't appear in the current year of 21. As of now, we have not seen any notification of that scheme either coming back or being notified in the current year.
So, sir, sorry, I'm just, so is this discontinued, or as of now it's discontinued? Is my understanding correct, or?
So we don't know, Gaurav, if it's been discontinued or not. Typically, it would get notified, and then, we would go ahead and take advantage of the scheme based on our foreign exchange earnings. As to whether it will come back or not, at this stage, it will be difficult for us to come.
Fair enough, sir. Thanks for clarification. And sir, just last question. Basically, it is related to research segment. So if I look at a Greenwich number, so the PBT margin for that entity will be around in high single digit. So I understand very much that we don't give guidance, but qualitatively, can the PBT margin of the Greenwich entity will be similar? Can it over a medium to long term reach the basically research segment PBT margin, or is this a fair understanding? I remember that one of the media interview, Ms. Asu Shuyas has clearly said that your endeavor as a company will be to reach a double-digit PBT margin for the company segment, which is there for the company segment. So can you please throw some color qualitatively? Not I'm asking for any specific guidance.
So Gaurav, the way we look at the business is an integrated benchmarking business, which is with our erstwhile or coalition business and the Greenwich business, because as Amish had mentioned, that these two are integrated businesses now, and what we call the benchmarking analytics business. And to your question, the answer is yes. We do target to get the benchmarking business to the segment margins.
Thanks, sir. That was quite helpful. And just one, I want to congratulate the entire team that I was just looking at annual report, page 95. So there was the number which has been given there is a 2,800 new client added in 2021. That's an amazing number. It's almost around 20% of the client addition. So congratulations to entire team and wishing you all the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi. Thanks a lot for the opportunity. Sir, could you just highlight the global side of the ratings business? How is the opportunity there? Because if we back calculate over last 4 years, this business is growing much faster than India ratings. That is question number one.
No, maybe I am not sure whether that is correct, but I would say that the global business that we have on the Global Analytical Center, which supports the global S&P Global Ratings, there we have been able to add new areas in terms of support like ESG and, with the pandemic, I think the requirement of surveillance, analytical surveillance has gone up. Event-driven reviews have gone up. So I think we have been able to increase and expand the work that we do for S&P ratings and also on other areas of interest which are there, which has continued to drive growth. I think on the rating side, as you know that there were years post ILFS where things were very different from a ratings industry perspective, and those numbers are visible to all. So I think you have to keep that perspective. I think they are two different businesses and they are driven very differently, in terms of areas of interest and how that business is operating.
Right. Sir, second question is that on the ratings volume side, so we understand that there is a credit growth is bottomed out. But could you just highlight that out of our ratings revenue, India ratings revenue, how much percent of that is driven by bank and SME ratings and how much of that is driven by bonds issuance, so that we can get, it's rough figures if you could share.
So I don't think we segregate the two on the rating side. Sanjay, correct me, because I don't think we don't share information, because see, also please understand that in a company which might have everything, you might agree for a composite amount of ratings to be done. It could be a combination of bank loan and bond market, right? So I think it will not necessarily be right to see it in that light.
Yeah, so let me answer it. We calibrate it. I think it's Amish is right. So for large issuers, when you have a fee arrangement, there it's very difficult to. It's a flat amount and you have basis points, but it's very difficult to find that out. And also it varies on quarter-to-quarter basis. So it'll be difficult to kind of put that. But the way I think the market largely functions, it's a overall credit growth. That's how I think we kind of benefit from it. So I guess it's not very easy to put that out. It changes quarter-to-quarter, sometime year-to-year.
Perfect. Thanks a lot, sir.
Thank you. The next question is from the line of Anuj Sharma from M3 Investment. Please go ahead.
Yeah. Thank you. My first question was on the regulatory and compliance opportunity. Now, could you just explain whether are these opportunities compressed for the next few years, or do you believe these are long-term opportunities if we exclude the ESG mandate?
So you're talking about the global research business? Are you asking?
Right. Yeah, I'm just saying, post GFC, we saw sharp mandates coming up and these were compressed. Do you believe the mandates are compressed in similar nature, or do you believe these regulatory compliance opportunities will keep coming along?
On the global side.
Yeah, the amount of regulation across the global businesses and the specific segment that we are quite strong in, which is the big wholesale banks, are certainly not about to reduce. It is increasing. There's a raft of regulation coming through on financial reporting around ESG. There's still all the other regulation that's prevalent in terms of the build-out and the protection of the capital base of the banks. So in that context, with the work that we've done up to now and the work that we have started building a niche for ourselves, we are well positioned to capture that. And we don't see that reducing in any shape or form in short order.
All right. Thank you. My second question is, we have done well by picking up mandates in the buy side. Currently, what would be the opportunity, or what would be the revenue split between buy side and sell side, and would there be bigger mandates in buy side you will be looking upon?
The buy side is definitely an opportunity for us because as you would have noted and as we've said as well, we've historically been quite focused on the sell side. So the buy side do present an opportunity. It is difficult at this point in time, and as we've said numerous times in the presentation, we can't give specific forward guidance, so it's difficult to say exactly what the revenue opportunity is, but you can assume that we will definitely have a focus on the buy side going forward.
All right. Could you at least share what is the revenue contribution or the split between buy side and sell side as of today?
Anuj, we don't give that split in the public domain. I'm sorry about that.
All right. And my last question is, could you just share the pipeline or the addressable opportunity in the international advisory space?
Sorry, which business are you talking? We don't have.
The infrastructure advisory international.
So I think there are, we continue to drive opportunities across emerging markets, right, in Middle East and in South Asia, in Africa. I think pandemic did see some slowdown in terms of the demand, but as we see the pandemic slowing down everywhere, we are seeing discussions across multilateral agencies and different countries to pick up investments on infrastructure, which augurs well from our advisory practice perspective. But keep in perspective that travel restrictions, requirements, so all of that have a bearing on that opportunity. But the traction in terms of discussions, in terms of RFPs, is way better than what we had maybe last year or the year before last.
All right. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is from the line of Preeti RS from UTI AMC. Please go ahead.
Hi. Thanks for the opportunity. So I wanted to understand a bit on your assessment of how the bond market share, the overall credit share in India is expected to pan out. So if you see over the last decade, bonds did gain market share vis-a-vis the bank's credit. So how do you see this pan out, and what would be the key drivers that you would look for this to improve further?
So is the question specific, sorry, Preeti, to the bond market, or you want on both sides, the bank as well?
Drivers on both.
Okay. So I think the drivers fundamentally, I think the bond market will have a good amount of investment happening from institutions which are not lenders. So it's mutual funds being pretty large players in the bond market space. So are insurance companies, bank treasuries to some extent, but that's and international players. I think that's your bond market. The bank, you would know, it's the Indian banking sector. So I think the drivers for both of these are GDP growth rates, and so obviously the bank credit usually is a multiple, 30-40% higher. Oh, sorry, 30-40, 1.3, 1.4, 1.6 of the real GDP growth rate. The bond markets are, I would say, fundamentally similar, possibly can grow at a slightly larger, higher pace than the bank. A, smaller base. B, I think with IBC, as Gaurav actually asked, IBC has a fundamental way of looking at things. Once you have a handle on loss given default, a lot of market players are interested in actually giving credit. Actually lending in that space. So we believe that's a positive kicker for the bond market. And thirdly, I think if you also look at some of the way the regulators have given a direction. So if you see, there is a large corporate framework by RBI, where I think they are also talking about credit beyond a certain size, both group caps as well as companies who are borrowing beyond a certain size. I think they are incentivizing them to actually borrow from the bond market rather than the bank loan market. They charge a little bit higher capital. SEBI has also put a framework for a AA and above companies to borrow 25% from the bond market. So I think these are structural things at play for the bond market beyond the normal credit growth, which is there for the Indian economy. So I suspect as we grow, and once we grow at say 6 to 7%, you would see credit being. I'm taking a ballpark number. I'm sure you guys have a better handle it, but let's take a 1.4, 1.5. I think when that bond markets would probably grow at a higher pace than the bank segment because of the IBC and the way some of the regulators are nudging more participation in the bond market. And you're also seeing financialization of savings. You see the growth in the mutual fund portfolios while a good amount of today is sitting in the G-Sec and the state government market. But structurally, if you adjust for risk-adjusted returns for a AA or a AAA category, you probably get better returns investing in corporate bonds. So I think that's the other incentives which we believe over a long term will come into play.
So the recent loss of market share, although marginal, you would think that's more transitional and not necessarily structural?
Sorry, I missed the question. Preeti, can you repeat it again?
The recent loss in bond market share, so you would see it more as short-lived and not necessarily structural.
Yeah, that's right. I mean, if you're asking the industry growth rate of bond vis-a-vis bank, yes. Typically, what we see in a rising interest rate scenario, bond market will tend to price the interest rate movement almost instantaneous. So which means if you are seeing a 20 basis point increase today because of whatever announcement the government makes, the next bond is going to be placed at a higher interest rate. But the banks, when they kind of do it, I think they look at more on a quarterly kind of phenomena and they look at what RBI's direction is. So I think they usually takes a while. The reverse happens when you actually see a stable or a declining interest rate market. So if suppose we peak at 8% and then start going down to 6, during that time bonds will price instantaneously and banks would gain to that. So you see a rising interest, bonds lose. Everything else remaining same, lose some bit of share to the bank, and when you're going the other way around, you could see very different situation and bond market actually gaining at the expense of bank. Does that help? Preeti?
Yes. Thank you so much, and good evening. Thank you.
Thank you. Ladies and gentlemen, in the interest of time, that was the last question for today. On behalf of CRISIL Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.